Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner,
Hari.
Good to see you, Hari.
Yeah,
oh,
man. Back live and in person.
Yeah, I know. It's crazy.
Yeah.
How have you been?
Pretty good. Pretty good.
Yeah. In this episode, we're going to be talking about share cannibals.
Yeah.
This is one of your favorites.
It is,
Hari.
actually.
Yeah.
I'm very excited about this discussion.
Share cannibals is it's a very interesting topic. I think it's sort of it's not really much talked about in the investing community, but it has such a big potential if you look at it from a long-term perspective.
Right.
It'll just compound your investment over time that much.
Yep.
So let's get into it. Actually, before we do, let's give our disclaimer.
Yeah. So this Value Investor TV podcast is a podcast that helps you understand and educate yourself on how value investing works. We are not your financial advisor. We don't know your specific financial situation. So if you need to make any investment or tax decisions, please contact your financial advisor before doing so.
Great. Awesome. So let's talk about this share cannibal, Hari.
Yeah.
Give us a little, maybe just some background on what that is and why it's so important.
Yeah. So you may have heard about, when we talked about NVR, right? So NVR was a home builder. We did that, several episodes ago. And what NVR does, and what any share cannibal does, is that they have reached a point where they're somewhat mature, right? They're a mature business. They have extra capital that they generate from their normal operations, and they apply that capital judiciously to share buybacks. And so what ends up happening is the company starts out with 100 shares outstanding, and over time they can reduce that number to by 90%. And so there's a great book called The Outsiders that looked at 8 CEOs who their capital allocation decisions, and those capital allocation decisions that they made had to do with when did they do buybacks and that kind of stuff. So just so you guys understand, buybacks, we get a lot of questions about that, and you may hear about it in the media. It seems like you're taking your money and then just spending it on shares, right? Wouldn't it be better to do a dividend or something like that? But so let's play this scenario out, and so that we understand what we're really getting here is, let's say a company has 100 shares outstanding, just for simple math, right? And they make $10 in earnings every year. And for the sake of argument, they have their share price is $1 a share. Okay, so the entire market cap of the company is $100, right? Because they have 100 shares outstanding and they have $10 in earnings. So the first year, they would, if they spent all of their money on share buybacks, right? They would reduce their shares outstanding from 100 to 90, right? And then every year subsequently, they don't grow any of their earnings. They don't have any, reduction in earnings. It's basically the same company it generates. And so then next year it's 80 and then 70 and 60 and so on, right? But when you look at it from the perspective of what do I get, right, from an earnings per share standpoint? Right?
I get in terms of I as a shareholder.
Correct.
Of the
I
company.
as the shareholder, right? So 100 shares outstanding, the first year when you get $10 in income, right, you are essentially getting $10 over 100 shares, right? So it's 10 cents. But the next year it's 10 over 90 shares outstanding, right? So you actually increase it. So when we get into year 5, your $10 of earnings is now, you've basically doubled your earnings without doing anything, right? They've reduced the share count by half.
Yeah. This is also earnings per share.
Right.
We're talking about earnings per share, and earnings to shareholders is what we're talking about here.
Right.
But overall earnings will stay the same. This is all under the assumption that earnings stay the same, but the share count is going down.
Correct.
By half.
Right. And we also assumed that the price didn't change, right? The price stayed at $1 a share. Right. Well, so the market cap decreases, but in general, what usually happens is the company will try and maintain, the market will try and maintain a consistent price to earnings ratio. So actually, when they get to $50 shares outstanding, what they'll actually do is to maintain that PE of 10, the price will actually have gone up from $1 to 5, right? And so what that really does is it helps you understand kind of what we are talking about here, is that by reducing the share count, they actually increase the overall, what you receive as a shareholder is all that you should care about, right? And so Buffett talks about this quite a bit, is that, a lot of the companies that he has bought in the last 5 years, he doesn't have the capital to deploy to buy, small businesses, right? Yeah. He's got $100 billion. He can't do that. But when you buy these giant corporations, they generally are at a mature state in their business where they're not really growing very much, but they generate a lot of cash. And so he looks for the ones that are going to cannibalize their shares and reduce that share count significantly. And so when you look at that, what you see is these companies that reduce it. So in the case, in the Outsiders book, they talked about Teledyne, and they reduced their share count by 90%. Right? Well, if you reduce it by 90%, the earnings per share for an individual shareholder without doing anything just went up by 10 times. Right? That's a fantastic rate of return, and they could continue to reduce their share count by so I think when we looked at NVR, they had reduced it from 2000 to 2018 by like 60% or 70%. So big reductions in share counts mean huge increases in share prices over time. Yeah, for sure. So I think share cannibalism is a very interesting idea, and it's something that everyone should pay attention to. But I want to point our directions to our discussion to share buyback just as itself. And one of the things that we have to be careful of is share buybacks are good only in some circumstances. Right. Hari did mention that share buybacks are great if companies are matured and the company is mature and there's not a lot of room for growth. Those may be some really ideal situations where share buyback could be exercised. Yep. But in cases where, for example, companies growing really, really fantastic at a fantastic rate, or if the share itself is very highly priced, share buybacks may not be the best option. So maybe tell us more about that. Yeah, so you bring up a really good point. Like a growing business is going to capture more market share, be able to build a bigger moat, be able to generate more revenue and more ultimately more profit, you would hope, more profit, by investing back in itself, right? And so when you have a business that has a high return on equity, right, and has a large market in front of it, right, and we do this every time we look at the checklist, right, we ask those two questions. Are they very profitable and do they have a long runway for growth? Well, then I want to see them put their money back into the business. But if they're a mature business, I don't want them to be trying to grow at all costs, right? And that is a CEO mentality, is they're incentivized to grow revenue, they're incentivized to grow earnings, they're incentivized to grow revenue. And they do that by buying into businesses that have very low rates of return. And so what ends up happening is their low rate of return means that your money is actually being wasted, right? So when we talk about capital allocation, that's really where this gets into, is what is going to return me the best rate of return, right? If I go into a lousy business, if I'm in a great business and I can't invest in it, right? If I put that money into a lousy business, that's not good for shareholders, right? Yeah. And so a lousy business in that case could be, I have a lot of money and I put it into a mutual fund or a bond, right? Like let's say I buy a treasury bill, and the treasury bill gives me 3%. Well, why am I getting 3% when you should return the money to me and I can go get a higher rate of return elsewhere, right? Or you can buy back your shares, get a higher rate of return, or you can invest in the business. Well, you can't invest in the business if they're mature, right? They've tapped out their market. They're not really going to grow. So that leaves you those two options: share buybacks and dividends. A lot of companies will do both. And honestly, I don't see the reason to ever do a dividend in that scenario, right? It's maybe you would do a dividend sporadically, but just paying back your shareholders, via a dividend is a pretty lousy way of getting money back to me.
Well, tell us more about that. Maybe just not to go too much in detail, but why is that?
Well, so let's imagine that in the scenario that you have, that you split your money between the share buyback and the dividend.
Sure.
Well, the dividend is going to be taxed because net income is taxed, right? So the net income is what is available to pay out the dividend, right?
Net income is taxed at the corporate level.
Correct.
Yeah.
And so at the corporate tax rate, it's now 20%.
Yeah, something like that.
And then there's state and local taxes, and so you're around 25 to 28% tax rate, right? Well, then the dividend gets paid, and then I get paid. I have to pay taxes on that, so it's a double tax that is effectively going to reduce my return, right?
Yeah. So, excuse me. So the net income is taxed at a corporate level, but then when you pay out dividend, it's also taxed at a personal level. Right. So it's double tax.
Right. And if you're making good money because you've followed this podcast and you've invested well, then you may be taxed at a 39% tax rate or 35% tax rate, whatever the highest tax rate is now. And so if that's the case, then your tax is not the double tax is really taking a huge bite out of your earnings, right? Now here's we talk about this all the time. Opportunity cost is a big part of how we invest, right? If I am being double taxed, that money could be spent to go buy my shares if this company is undervalued, right? If they're undervalued, I'm basically getting more for my dollar, right? Because I'm buying my shares and retiring them. I'm getting that dollar, but I'm only paying 50 cents, right? That's a really good way of doing it, right? Now, if I'm really overvalued, right? They do this in the Outsiders book. They actually, maybe it makes sense to pay for another business with my overvalued shares,
sure,
right? Instead of paying for, because I'm getting $1 in a new business, but I'm only paying 50 cents for it because my business is overvalued
through shares,
right? So I may be diluting myself, and nobody likes to dilute themselves, but then I buy this new company with shares, I save my cash, and then when the stock price is undervalued, I go and buy my shares out.
Yeah.
So that is good capital allocation.
Yeah.
It's looking at all of your options and then putting your money where you're going to maximize shareholder return.
Yep.
Now, when we look at that over a long period of time, and the Outsiders books, talks about this. Some of the CEOs in there are Warren Buffett is one of the main ones in the book, but their rates of return are in the 25-30% range purely because they allocated capital very effectively and put their money where the shareholder would get the main return, right? So every CEO is charged with this, right? That is their main purpose in life, is to maximize shareholder return, right? That's your job. Is literally your job.
Yeah.
And so it is not to, shepherd, the company through a period of transition and all this stuff. Whatever they tell you, the board has said when they hire a new person. No, their entire job is to maximize shareholder returns every single time. That's the reason businesses exist. So if the CEO doesn't do that, you should be looking at other companies, right? That's kind of the idea that we're talking about here.
So I want to go back to our original discussion about share buybacks. The share buybacks, and also, the reasons why you said dividends are not great because there's double taxed.
Right.
Now we cover that topic. Let's go back to share buybacks again. Yeah. So share buybacks are good in only in certain, when the situations are right, share buybacks are great.
Right.
When situations are not great, you shouldn't be exercising share buybacks for a number of reasons that you mentioned.
Correct.
And so maybe let's enumerate some situations where share buybacks are not great. We talked about a few of them. So, number one, when share price is really high, you don't want to exercise share buybacks.
Right.
So that's number one. Number two would be maybe another example.
Yeah. So
on that bullet point,
let me give you a good example actually of the when the price is too expensive.
Sure. Let's do that.
So GNC was a company that they're the nutrition company that makes vitamins, and they have their retail store and they sell their own vitamins and other companies' products. And for a long time, GNC was a very fast-growing business, very profitable. And about 5 years ago, they kind of reached a peak in their number of stores that they could have.
Mm-hmm.
And they were trading at around $60 a share, and they were very expensive at that price.
Mm-hmm.
I mean, you could make the argument that they were fairly valued. I would say that they were expensive, given that they had very little growth. So the board authorized $1 billion debt, multiple bonds,
Mm-hmm.
to do a share buyback. So they bought back the shares at $65 a share. Well, then the retail apocalypse happened, and fewer people were going to the stores, and fewer people were buying it because Amazon and competition and that kind of stuff. And their earnings took a hit. Well, when their earnings took a hit, the stock price tanked. And when the stock price tanked, they went from, $2 or $3 billion company to a $250 million market cap. And their price went from $65 a share to $6 a share. And so they bought at the most expensive time that they possibly could. And their share buyback was essentially now, and then they were saddled with a bunch of debt that they couldn't pay off because their earnings moat had basically evaporated.
That's double whammy right there.
Yeah, so they got killed on both sides.
Yeah.
So when you look at it, this is why we hammer on these concepts around the checklist, right? Is I find a good company that is on the value investor checklist. I want to make sure that they have a moat, right? Because share buybacks aren't good if your moat is evaporating, right? That's not going to help you, right? At that point, actually, a dividend may be the only option, right? Is pay my shareholders out and then let's shut down the business. That's actually the appropriate thing to do. Companies may not do that because they're too arrogant and they think, well, we'll just keep going, right? So that's where GNC kind of failed, right? Is you way overpaid for what you could have had. You didn't need to load up on debt, to buy back a share,
Mm-hmm.
right? You should have just used your existing cash flow, and you should have waited until the price was right.
Yeah, for sure. And I think that's a great example. You're taking out debt to buy your share at an all-time high price. I mean, that's double whammy right there.
Yeah, and you're paying, I'm buying $1 for $3.
Yeah.
Who would do that, right?
It's a great example of destroying shareholder value, minimizing shareholder value.
Right.
Yeah, so that's case number one. When share price is too high, you don't want to do buyback.
Correct.
And case number two is when your existing business is growing so fast, it's a great opportunity to put money back into the business and grow the business.
Right.
That's a better use of capital than going out and buying your own shares. So that's second bullet point where, when share buybacks, I guess the other way around. Sorry. So the bullet point number one was when share price is too high, you do not want to buy back your shares. Bullet number two is when your business is not growing.
Yep.
When your business is growing, you don't want to do that instead of going out and buying shares.
Correct.
So those are two different situations where buybacks may not be appropriate.
Yep.
But on the flip side, so you can take the flip argument that when the business is selling for a cheap price, when the shares are cheap, and when the existing business is slow, in those two scenarios, it would be great if a company could exercise some buybacks.
Yeah, so like if we look at, we're recording this in July 2019, right?
Mm-hmm.
And the Dow hit a record 27,000 this week. And there are a lot of companies that I look at and I'm just like, there is no reason for this to be expensive, right? I mean, it's, trading at 30 times earnings.
Mm-hmm.
They are not growing. They have nothing really going for them. But people are putting money into it for whatever reason, right? So when things get really expensive, people really do dumb things, right? I mean, I've got news flash for everyone that people are dumb.
Oh my gosh.
So they are thinking with their wallet and they're not really paying attention to what happens if this thing crashes, right?
Mm.
Like instead of stockpiling your cash when times are good, you're spending it trying to, catch growth that isn't going to occur, right? And so I think that's why we're seeing a lot of this is that the Fed has lowered interest rates. People are putting money into stocks that don't deserve to have high valuations. And then the companies feel like, well, they have to keep their lofty price, and so they do that by buying back shares and doing more things that are, to sustain themselves, right? And then they chase growth opportunities that may grow revenue in the short term, but then actually lower the profitability of the business.
Yeah.
Right. So those are the kind of things where people allocate capital poorly, and share buybacks is one way that could be. You look at companies like, that pay a dividend for a really long time, and they're very reluctant to suspend their dividend because then they think everybody will exit, right? The stock price. Well, you need to do what's best, not for the share price, but you need to do what's best for the company in those situations, right?
Shareholders.
For shareholders, because that'll effectively improve the, suspending the dividend should be, something that you should, be readily, doing, because if the stock price is cheap, what you should do is buy back a bunch of shares at that price, because that is what's best for the shareholders in that case. And what people do is, well, I'm tied to this dividend, so I may end up borrowing money just to pay the dividend. So a lot of the oil and gas companies actually were doing that in 2016 when the price of oil went from $150 to $20 a share, $20 a barrel. Yeah. They borrowed money just to maintain their dividend because, things will pick up. We're not making any money right now. Well, when that happened, if you instead what you did was you said, we will not pay a regular dividend. We will just one-offs pay dividends whenever we feel like the share price, when we have excess capital. And instead, what we will do is we will wait for the price to be low and buy back our shares. Two things will happen. One is you will prevent any sort of run on your shares trying to push them down, because the share buybacks will kind of eliminate
floor.
That. Yeah, it's a floor.
It's a setting a floor on the price of a share.
Exactly.
Yeah.
And the other thing that it does is it eliminates any you're making a decision as to when to buy, like the value of the stock, and then you stick to that price like any other value investor would. We would say at $50 a share, it's not a good price, but at $40, it's a great price, right? Because price matters in how we approach this stuff.
Sure.
That's where I think a lot of people get mixed up, So keeping track of those things is how, you reduce the overhead here.
Yeah. So going back to our main topic, which was share cannibalism. Share cannibals, like we said, these are companies who are opportunistically buying back shares and ultimately yielding great shareholder value at the end of 10 to 15 years of long-term shareholder buyback strategy.
Yep.
And a great example of that we covered at a company called NVR. So if you haven't checked that out. Maybe a couple episodes ago. Yeah. So really, ultimately, share buybacks, if used appropriately, could really maximize shareholder values.
Yeah, and there's just going back to the NVR example.
Sure.
Because I think this is important. So the question is NVR buying their shares when they're reasonably priced?
Sure.
And here's the funny thing about the home building industry, and also we talked about Southwest Airlines, who is also a good share cannibal.
Mm-hmm.
So both of those businesses actually operate in a industry where Wall Street doesn't give them a high premium. Mm-hmm. So their price to earnings is actually frequently, under 10 or very low. So most of the time their buybacks are always effective. Mm-hmm. So NVR has blanket bought since, 2000. And that may purely be because they're just in a good industry for that to exist.
Yeah. Good industry in the sense that Wall Street doesn't value them as highly as them, like say a tech company.
Correct. And so buying back their shares, it's not necessarily that they're opportunistic. It's just they're always cheap. Mm-hmm. And so it just kind of works for them. Mm-hmm. So I don't want to, maybe they are very smart about their buybacks. I just can't tell because their behavior is we just constantly buy it back. Mm-hmm. And so it works out well for us, right, in both cases. But we should be thinking about that when we look at this. Are they managing my money well, right? Because I own this business. I'm going to invest with the idea that they're going to manage my capital well. And so are they being opportunistic? And so what is funny about this is the best businesses that are cannibals are typically some of the older, more lower PE businesses because they're in industries that just don't get a high valuation. So
yeah, interesting to kind of think about as well. Just sort of different types of industries that might be more maybe suited, maybe is the right word here, but suited for blanket buybacks.
Yep.
Okay. Anything else you want to add before we close out this cannibal episode?
Yeah, we'll actually talk to you a little bit about what to look for in the next episode for Share Cannibals.
Sure.
Because I think there's a lot to discuss here, and I think it's actually, we came upon this idea basically by watching what some of the great investors do. Monish Pabrai and Warren Buffett are both big proponents of the Share Cannibal kind of. I think Charlie Munger also, and so that's why we wanted to talk about this. And so in the next episode, I think we want to talk about how to find these businesses. What to look for when you do find one, and then how to evaluate them.
Sure.
For which one would be the best one to put into a portfolio.
Yeah, sounds great.
And then, do you want to just tell our listeners about helping us out with?
Yeah, for sure. Yeah, so we're really grateful for all the listeners who've been sending us emails and tweets, for support and just being there for us. And I think what could be really helpful for us as we move forward is if you could go to Apple Podcast and just give us a five-star rating on there. I think that would really help us to get ourselves out there and to promote this platform for people who are interested in learning about investing, who wants to take control of their life, take control of their financial health, and so. Please help us. Go to Apple Podcast and give us that 5-star rating. That would really help us out.
Yeah, it'd be really helpful. Thank you.
All right, guys. We'll see you on the next episode.
Yeah, thanks.
Thanks.